If you're flipping real estate, there may be a hidden tax time bomb waiting for you that you're not aware of. In this video, I'm going to teach you what that is and how you can minimize it. All right, let's get started. Okay, so here's the deal. When it comes to flipping real estate, you really need to be careful about how you structure your sales. Now, what I've been noticing more and more with these higher interest rates right now, people who are flipping real estate are looking for ways in which to get buyers into their properties, but they don't understand the negative tax ramifications that can come from structuring some of these deals. Let me show you exactly what I'm referring to here and what I've been seeing out there when it comes to flipping property. So let's say you've got your corporation set up right here. This is either going to be a C or an S. Now, I'm not going to go into the benefits of one versus the other and why you want to choose it per se right now. I'll save that for another video. But I do want to say that when you're flipping real estate, generally speaking, what you'll be doing is you create those separate LLCs up here. Each LLC is owned by your corporation, and you should be flipping the properties out of these separate LLCs. Now, I have plenty of videos on my YouTube channel here that discuss this type of strategy and its benefits. And if you haven't yet done that, check the show notes for one of my videos below. I'll put a link in there on how to flip property, what is the proper structure to minimize your liability exposure. But for purpose of this example, if I'm flipping real estate and I sell this property to, let's say, this buyer right here, and I'm selling this property that I bought for $80,000 and I put $20K into it to rehab it. So my tax basis, let me just put basis here, equals $100K. Now I sell it to this investor, sales price equals $140. So I'm selling it to $140,000, but the investor, maybe they have some tough credit, they just can't qualify right now at these higher interest rates, and I want to let them get into the property, and so I'm willing to carry the paper. And so what I'm seeing flippers do in this environment is enter into a type of sale that's referred to as an installment sale. Okay, so what is an installment sale? Well, it's basically means you're going to be the bank. You're going to carry a note back or a deed of trust against that property, and the buyer is going to be paying you over time. Just like it is if you went to the bank, you got a loan to take out a mortgage to buy a house, and you're paying the bank over time. Well, instead of you paying a financial institution, you end up paying the seller. So the seller will oftentimes in an installment sale negotiate the terms just like a bank if you wanted to borrow money. So maybe with this investor, I tell them, hey, here's what I'm going to do for you. I'm going to sell it to you for $140,000. I want a down payment of $8K. And the terms of the loan are going to be as follows. It's going to be a 30-year amortization at 6% interest. So that means your payments are going to be lower because I'm going to amortize the loan over 30 years. So that drives the payments down, and it's going to be at 6% interest. So your payments will be $800 a month. Okay, but I'm going to put a 2-year balloon in there. So then you're going to sell me the property, or you're going to have to refi this property within 2 years. So what we're hoping for now is that the interest rates are going to go down, so it's more affordable for you. B, you're going to get your credit fixed if that is the issue right here. So that's kind of common right here, what I'm showing you. So assume for purposes of my example, and you're going to see where the tax hit comes in, which really screws you up big time on this deal. Assume for my example, you did this in January, because if you sold this property right now in November or December, depending on when this video hits, hey, this could really screw you up for the year. But let's assume that you have plenty of runway here, because I think it works out better this way to show you what it is and not really scare the hell out of you, although we could. So you sell it in January. So you have one entire year of payments that are coming in. All right, $800. So over the course of the year, you're going to bring in from this buyer $9,600 in payments. Now the question is, how much of that is going to be taxable to you? So in a normal scenario, what you're going to do is you're going to allocate the difference between interest and principal payments here. So on this type of structure right here, I will have brought in $7,800 in interest. in interest from that loan at 6%, right? So they're financing 132,000 because they gave me 8K down, and at 6% interest. So of those, that $800 payment they're paying every month, at the end of the year, $7,800 that is going to be interest. $1,600 will be principal. Okay, so I got $1,600 in principal, $7,800 in interest that comes in. All right, so let's talk about the taxes and how that works out on this sale. Now, assume that we have a C versus an S corporation. I'm going to give you the C first, then we're going to talk about an S corporation. So if I sold this through my C corporation, you're going to pay 21% on that interest, that $7,800 I drew up there. So 21% of $7,800 is going to equal $1,600 in income. So I'll have $1,600 in income on just taxes that I have to pay just on that interest income. Now, on the principal portion, remember, because we allocated it, if you look back here, we did the difference between principal and interest. When I said, hey, there's $1,600 here in principal. Well, the principal is not all taxable to you because part of that is your tax basis. Remember, we bought the property for 80, put 20 in, that's my tax basis. So the gain's only $40,000. So what you do is you just do a calculation. You say, all right, of that amount of the sale price, $140,000, 30% of the money I bring in is going to be considered taxable to me because the rest is a return of my basis. So all we need to do then on the principal side is say, all right, I brought in $1,600. So if we're at a 21% tax bracket, of that $1,600, 30% is taxable. So that gives us $90 in taxes that we have to pay on the gain portion of our interest. So the total tax liability here is $1,690 if I sold it through a C corporation on an installment sale. I haven't dropped the tax bomb yet. It's coming. You'll see it. Now let's assume that you used an S corporation instead, just to give you some comparison, because an S corporation is a flow through. And this is where it gets even worse. So if I sold it through an S corporation, which is one of the reasons I tell people to flip through C corporations, let's say your effective personal rate is 30%, because an S corp, again, it all flows down to you. So if I'm in a 30% tax bracket, then my taxes on the interest is going to be $2,340 off to pay in taxes. And the taxes on the interest that I'm going to have to pay is going to be $135 in taxes. So my total tax liability then, if I sold it through an S corporation, is going to be $2,475. All right, so you can see right away by using a C corporation, you're going to get some benefit there. You're paying less in tax on the money you're bringing in because of that lower tax bracket. People often talk about double taxation. Don't worry, that's not an issue, and I have other videos that discuss that. Now, here's the problem, okay? Because you flip property, you're considered to be a dealer. And as a dealer, you're not entitled to account for your income like I just showed you, right? You're not allowed to do this because dealers are forbidden from using installment sales because the property that they sell is considered inventory in their hands. So in this scenario, this situation might look good to you. It does not apply. What happens with a dealer, when you're a dealer, is that the IRS is going to look at that sale. So in my example, remember, how much did our rental income equal? Not our rental income, our payments from our buyer. So our buyer paid us this year $9,600 total, $800 a month, plus $8,000 is what we received from the buyer. Now, the taxes is for a dealer, someone who sells. They don't get the installment sale. What they do on the dealer side is they say, all right, you sold the property for $140,000. Your tax basis was $100,000, so you have $40,000 in taxable gain that you have to recognize. So you have to pay taxes on that. So if you were in a 21% tax bracket, like I just talked about earlier, now instead of only paying taxes on that small portion, you go back here, remember the small portion of principal of $1,600 you brought in, we did the multiplication, 30% of that. That's taxable. In this case, you have to pay taxes on the full $40,000. You don't get to break it up any longer. So what ends up occurring here at 21%, you're going to pay $8,400 in taxes on that money. plus you have $1,600 in interest. That equals $9,600 in taxes. All right, now if you're at 30% tax rate because you're doing an S corporation, now you're at $12,000 in taxable income plus $2,340 on the interest you received. So now your tax liability is $14,340. Okay, so when you look at all this together, what you find is that if you flip property and you use the installment sale, even though you only brought in $9,600 from your buyer, you're going to be paying tax. Oh, I said $9,600. It's not $9,600. Here it's $10,000. Excuse me. You're going to be paying tax on the full amount of that sale. So when I look at my finances, sometimes depending on where this sale took place, remember I said later in the year it's going to be worse for you? This way you had a full year of runway to generate payments. So you've got enough money to cover your tax liability. If it was sold through a C corporation, between your down payment and the payments you collected from the tenants every month, you have $17,600 in cash sitting in your bank. You have a tax liability of $10,000. So now you're $7,600 to the positive. You still got cash to pay it. Whereas if you used an S corporation, again, you've got $17,600 in your bank, but you have a $14,340 tax liability. So you're what, $2,660 to the positive there. But what impacts this? You have to be aware this is your flipper. That what's going to impact how much money you have left over to cover your taxes at the end of the year is going to be driven by how many payments you receive throughout the year. So in my example, if we sold this property in November, then I would only have received $1,600 in payments from my tenant, plus the $800. Now you can see I can run into problems here where the amount of money I'm bringing in may not cover my tax liability because I don't have enough runway to have enough payments. Because as flippers, we flip property throughout the year. We just don't sell everything in January. So the amount of payments you're going to receive are important. Also, the amount of down payment you ask for is really important as well. Because I've worked with flippers that will do this, sell their properties on installment sales, and they find out that they don't have enough money in their account to cover their tax liability. Because the other issue they run into when they're flipping property is that they take those gains and they turn around and they go out and they buy more real estate. So they constantly have deal flow going on. And so as a result, their cash flow can be quite small when tax time comes about and they have to pay their taxes. So if you want to make sure that you do not fall into this dealer status, you're trying to keep your corporation out of being taxed as a dealer on those installment sales, you may want to consider another strategy on how you structure your deals, which I'm going to show you now. So it's a bit aggressive, but what you might want to consider doing is, here's my company. And rather than going up and creating these separate LLCs, which you should do for your normal flips that are cash flowing flips that just flow down here and you sell the property outright, for those that you think you might do an installment sale on, consider setting up, instead of an LLC, consider setting up what is referred to as a limited partnership. Now, in this case, your corporation will be the general partner of your limited partnership. And the property itself is now going to be flipped out of the LP. And so you're down here as a limited partner. Your corporation is referred to as a general partner. So you flip the deal out of this limited partnership and you get the limited partnership because it's only doing one deal. The limited partnership, unlike the LLC, which is treated as owned by the corporation, the limited partnership is really owned by you. We'll set it up so that I owned 99% of it. I give my corporation 1%, or you could change those numbers if you want a little bit more of that money flowing to your corp. But however you structure it, then you're not the one doing the flip, or your corporation isn't the one doing the flip any longer because it doesn't own the property. The limited partnership owns the property. So it makes your tax return look cleaner for those installment sales, because this, you're going to have to file a tax return for this entity. It's going to give you a K1 and you're going to show that installment sale income, but this entity only has one flip. That's it. It doesn't have multiple flips that roll you up into that dealer status. So this entity here has a flip, so that rolls down to you. In this scenario here, all that income is showing up on the corporation. It's showing multiple flip properties. So this is definitely the big D. These are the dealer. This is a small d down here. Possibly they might pick it up as dealer status, doubtful. So if you're doing the installment sales, you want to make sure that you have plenty of cash flow to cover your taxes. You want to minimize that risk of having all your gains compressed. You may want to consider switching to this other type of structure for your flip deals, using a limited partnership for those installment sale deals. If you don't plan to sell on installment sales, just stick with this right here. Don't do the other route. Don't go this route. Only save this for the installment sales. I think it might give you a little more flexibility, a little more cash flow availability for those future flips that you're going to be doing. Hey guys, if you liked the video, hit the like button, and I wish you the very best with your investing.